This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by SmartBooks, provider of bookkeeping and accounting for businesses. Let's get started. Hey, Greg, welcome back to the show.
Thanks for having me again.
So what are we talking about today?
So it's summertime and everyone's kids are in camps, and I figured it'd be a good opportunity to talk about the child tax credit and the child and dependent care credits.
So how to deduct our kids' tax, or how to deduct our kids' summer expenses on our tax return.
Yep, and I know from personal experience that it is very expensive, so we'll take all that we can get.
Absolutely. So what's the high level concept here?
Yeah, so there's two kind of credits here. So you have the child tax credit, and then you have the child and dependent care credits, right? And your the child tax credit is up to $2,000 per qualifying child. So typically, your child under the age of 17, um, to help reduce your tax bill. And then you have the child and dependent care credit, and this is for what I think most people think about. Like kindergarten or not kindergarten,
Preschool?
like preschool, daycare, stuff like that. And what people don't realize is that there's opportunities in that child independent care credit that you don't always think of. So hopefully bring that to light. And with the passage of the Big Beautiful Bill Act, those have been adjusted slightly for taxpayers. So there is some change there this year for people.
So what's the top level concept? If you're paying for somebody to take care of your kids so you can work, is that tax deductible? That the general theory?
As long as you are working or you are looking for work, you and your spouse, then you can deduct up to $3,000 per for one child, or $6,000 for two or more children, and then that is subject to a percentage. So I believe it's like 20% of your of that amount, and then you get that as a tax credit. And let's keep in mind that a tax credit is a dollar for dollar reduction of your tax bill, right? As opposed to a deduction, which is a is taking off your taxable income. So we always want credits.
Okay, so let's say I make $100,000 salary, run my own small business, and in the summertime, my kid's out of school, and I spend $5,000 on an afternoon soccer camp where we drop the kid off for a few hours, my wife and I, then I go work, and then I sometimes go pick up my kid at the end of the afternoon.
Yep.
Um,
So at tax time, you'll call up the organization. This is usually a pretty standard ask for them, and most organizations like the Y will print out a form for you that has like the name, address, EIN number, and how much you spent on whatever like care program it was. So if you do a summer soccer camp, it would be the 5,000 that you spent on that, and that's your burden of proof, right? You hold on to that, you give that to your tax accountant, and then they will plug that into the child and dependent care credit. Now keep in mind the child and dependent care credit is for children up to the age of 13, or for dependents who cannot take care of themselves either because of like a physical or mental limitation.
okay, so my example is good until they hit to be age
Until
14,
they're
and then they're supposed to take care of themselves in the afternoons, I guess.
and then they're on their own. Yep.
Okay, all right. Now, that seems kind of like a gray area, like, there must be some rules of thumb, like, if it's a 4-hour camp versus a 1-hour activity, where is it? Like, what are the
As long
guardrails to be
as
aware of?
as long as you're putting them in that program so that you can go work. Um, so if obviously if you're putting them in a program at well, I don't even if maybe you're working at night and you got to put them in like nighttime basketball league or something. As long as it's for you and your spouse to go work. I think the nighttime situation might be a little bit harder to justify if one spouse is home. But during the day, you got summer camps. I know that for us, my daughter does cheer, and so that costs us. It's not a huge expense, but like $300 a year. She's at after school every day for that. So that is an expense that we can take. Now, a lot of people will try to sneak by like private school. So like if you pay for kindergarten, I know I mentioned kindergarten earlier, but kindergarten is where it stops. So you can have um, like preschool, daycare, before and after school programs. I know a lot of schools will offer like a before school program that you usually have to pay for. Um, so that people can get to work. I know my daughter's school starts at school drop off is like 9:15. So most people are already through a couple of meetings by then. Um, and then overnight camps, those are eligible. Day camps. So summertime is usually a big time where I'll be talking to clients in April and be like, oh, did your son or daughter go to camp this summer? Oh yeah. And all of a sudden it's like, yeah, that was so expensive. Well, that's actually a deduction.
Okay. All right. So, care for the kids so you can work is deductible. And is that on top? And you said there's a limit to that, right? Or no?
Yeah, so it's up to $3,000 for one child or 6,000 for two or more.
So if you have 6 kids, you're still limited to 6,000.
If you have six kids, then I pray
Good
for
luck.
you.
You got bigger problems to fry. Okay.
Yeah. If you have six kids, the chances are you've got at least one or two that can hopefully help out, taking care of the others. Um, Now you can also this also applies to like nannies. That's a little bit of a gray area. Technically, if you pay someone, I don't know the exact limit, but I think it's over like $2,000 or so a year. You really should be putting them um, on payroll. It becomes very frustrating, and not many people do it unless they have a full time nanny in their house. But that those are the rules. And then you would have taxes withheld. They'd pay federal and state payroll taxes, and then you could take um, whatever you pay them as a tax credit. Um, I would say that if you're paying, the high school student a couple times a month to watch your kids so you can go out on a date, that does not qualify.
Okay. Have to be legitimately working. Got it.
Yes. Yes.
Okay.
Um, yeah. And then obviously the other one is the child tax credit, which is pretty self-explanatory. That does, I believe that one phases out over if you make married filing joint, you're making over 400,000, or single, you're over 200,000 in AGI. So most people get that. It's kind of a no-brainer. It is a little bit of a shock to people when they lose it, though. I had a couple of clients this year who got an unsuspecting tax bill, and that was the reason.
Huh. So, I moved to a town. Partly the reason I moved here was because the public school district was solid and wanted my kids to get a good education like every parent does. But when it comes to, you mentioned, private school bills and potentially college bills, in what scenarios are, private elementary and high school or college bills deductible, if at all?
They are never going to be deductible, but a few years ago, the 529 plans were opened up to include not just colleges, but also um, private schools. So
So,
you can
like
use
private high
a
schools?
yeah, you can use a 529 plan for um, in that instance, or at least I know that's true in Massachusetts. I know 529 plans are state by state, so
Okay.
you may want to double check that. But
You really want to open those things like right away when the kid's born, or maybe even before the kid's born, right?
yeah, I mean, if you do it when they're in sixth grade and you're contributing to a 529 and then you're pulling it out a year later, it's really not going to do much for you. But
Yeah, you're taking a lot of market risk, and anything can happen in a few years' time in the market. So
yeah,
early is
if
better.
you're a business owner, 529 may not be the most advantageous way to go. We can get into like paying your kids and putting it into a Roth and then having that, build over time tax free. So like there's other ways to move the money around to be a little bit more advantageous for your kids. Um, but if 529 plan is in your future, then that's something that you definitely want to start earlier.
Cool. Has anything really changed significantly with the one big beautiful bill in this area, or are we just kind of going off what we've had as guidance for the last several years from the IRS?
So some of the amounts have gone up a little bit. So for lower income families who are paying for the child tax credits, child and dependent care credits, um, you can actually deduct more. So 35% of 6,000, which I believe, I don't have those numbers in front of me, but it goes from 20% to 35%. So if you're between adjusted gross income of 0 to 15,000, um, then you can take 35% of the 6,000 that, you know, 3,000 or 6,000 that you're spending on dependent care expenses. Um, that's a pretty low number for AGI, especially in Massachusetts. So I think a lot of people are probably going to be in like the 20%. There is a phase out range between 20 and 35, between 15,000 of AGI and 43,000 of AGI. Again, pretty hard to live off of, Massachusetts, let alone the less rest of the country at 43,000 AGI. Um, so I'm not sure how many people will qualify for that, but there is some enhanced credits for lower income households.
Cool. And then one final question. I hear reference in the news to a, marriage penalty or marriage advantage. I always see, differences in tax impact if you're married filing jointly versus married filing individually. And almost all the time, it seems to make more sense to file jointly if you're married with your wife or your husband. But what are the scenarios in which it makes sense to file independently?
It's very rare that we come across a situation where it is where it makes sense to file independently. Um, I can probably count on one hand the amount of times that it made sense to have clients do that over the years. Um, the marriage penalty has to do more with like the phase outs. So you would think that similar to the child tax credit, which phases out at 200,000 for single filers and 400,000 for married filing joint, that makes sense, right? You have two incomes, two people working, and you would think that it would double. Um, Oftentimes phase outs for other tax credits and tax deductions, it's not doubled for married filing joint. It might be, only like $50,000 higher, say like 100,000 single and 150 for married filing joint. And that's where the marriage penalty comes in, because you're earning so much more income potentially with two people, but um, you're phasing out of deductions more quickly. Obviously, you get things like the child tax credit and child dependent care credit, so it might even out a little bit. Um, but yeah, typically, so our software actually runs that analysis, um, and it's very rare that it makes sense to do married filing separate.
So, the care for children so that the parents can work. We talked about the child independent care credit working until the child gets to the age of 13.
Yep.
But what about, between the age of 14 and 18? What can be expensed for child care for kids of that age?
Well, if you're a business owner, so a lot of people who are listening to this podcast, that's a great opportunity to potentially hire your kids. And so now you can add them to payroll. They can, I mentioned like the Roth
Because they need
contribution.
earned income in order to contribute to a Roth, right? So they
Correct.
need a
Yeah.
W-2.
Yep.
Yeah.
Um, and so that's a great opportunity to add them to payroll, take a deduction. At 14 years old, they are eligible to work, which I think that's where like the 13 age comes in to play. I don't think that's just a random number. And and yeah, it's a huge benefit to the taxpayer, but it's also nice for the child as well.
Right, because we could do a whole another episode on the benefits employing your children, but if they're doing something for your business and you can pay them up to what, 13, $14,000 a year, basically free of federal tax
Uh,
and free
yeah,
and
and then
largely free
you
of
got to
state
look at.
tax, but maybe you have to pay a little state tax.
I think now it's like if you're gonna pay them the top limit, I think it's 15,000 now. Massachusetts, you're looking at like 300, $400 of state tax, so not a huge expense.
Yeah. Cool. Well, awesome, Greg. If folks want to get in touch with you about questions about child expenses and deductibility, what's the best way for them to reach you?
So best way to reach me, you can reach out email. That's greed@smartbooks.com. You can also go to our website, smartbookstax.com, and book a meeting with me there. Um, we are coming, as I know it's still July, but almost August at this point, and we're getting close to fall. So tax planning season is, knocking at the door. So, if you're kind of worried about your taxes this year, or not too sure how this tax law is going to affect you, we can certainly help out with that.
Awesome, Greg. Well, thanks so much. Until next time, talk to you later.
Thanks a lot. Bye.
Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage SmartBooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.